You're with us on BTTV as you usually are, 3 o'clock in the afternoon. We're counting down to close and taking a look at how markets have fared, and we're continuing with that steady trajectory we've been seeing the last few sessions. Just a minor, bias towards the negative as of now, but overall it's, it's been pretty steady. Still at, if we just pull it up for you, the Nifty and the Sensex still well above those high levels around the 62,000 mark on the Sensex, just a tad under, and Nifty well above 18,000 right now. 18,350 is where we're trading at as we speak. Where's a bit of the pressure coming from today? The market slightly, some of those IT names, auto names, Titan is down 2.5%. So we'll pull up some of those losers for you to give you a better sense of perhaps where the drag is coming on the index in today's trade so far. We've also got Mr. Chokkalingam with us. Let me welcome him on the show. Mr. Chokkalingam, great to have you. And especially, with the markets having hit these new highs of late and treading water at these levels, what do you feel is going to be the next cue that markets look for? Earnings are a bit more or less behind us. Global cues for the moment seem to be stabilizing. What do we watch out for next?
Next is only the oil price. There are a lot of indication that the Fed rate is going to be modest, the further hike, and probably at around 4.75 or 5%, the US Fed rate is going to
recording in progress.
Not like 1980 when it went to 8%. That's not possible. And market is also, coming to a view that the further hike will be modest. And therefore, that is not a concern. As you rightly said, the earning also almost over now. So therefore, in my firm view, what trigger the market would expect is the oil price, because that is a single most important factor for Indian economy, whether you talk about the rupee exchange rate or forex reserves or trade deficit or inflation or for the raw material cost for many corporate. The oil is the single most important at this point in time. So since the economy is correcting worldwide, I believe the oil, which has gone close to $100 now, around $92, might correct below $90. So any such significant correction would give another trigger, and therefore officially we have stated that both the Sensex and overall market cap of entire BSE listed stocks would create another very high record level before December 31st, 2022, which means Sensex should close substantially above 62,200. The overall market cap of all listed stocks on BSE should be substantially more than 287 lakh crore rupees. That's my firm view. The only risk to this view is any flare up in the oil price beyond $100 per barrel.
All right, so that's the only one major risk factor, and we'll also talk about, how that could play spoil sport on particular key pockets of the market. Just taking a look at some of these new listings as well, Mr. Chokkalingam, and I know that you don't necessarily track them very closely, but what's your sense? I mean, with that nosedive on Paytm, after SoftBank unit has cut a stake in the company, it's down about 10%, and we already know it was looking weak. Would that be a clear avoid, or do you see any merit in Paytm even at lower levels?
I would not advise retail investors to buy even at current levels. My firm view is that even from current level, some of these e-commerce companies which are not yet making a significant profit to justify the valuation can correct another 15-20%, because most of these e-commerce companies, before they could complete the venture capital cycle, they rush to list the stock. In the sense, normally you would expect any new stock to list after establishing a creditable profit track record, but some of them rush to the market without having a significant profit stream. So in my firm view, the venture capital process, the life cycle of venture capital investment is not yet over for some of these stocks. And look at, as you mentioned, SoftBank selling, see, even after stocks are corrected so much, more than 50-60%, they are willing to sell. That shows that the lack of confidence in these stocks by them, even after they have fallen 50-60%. And that's because the bottom line is not sufficient enough to justify. So therefore, I would suggest retail investors to stay away from most of these e-commerce stocks.
All right. What are some of the picks that you have from the broader markets, Mr. Chokkalingam? Because I know that you're always spotting some of these, trends and multi-baggers, potential multi-baggers. So what's on your radar at the moment?
Yeah, one multi-bagger is Nesco, in my view. Personally, Economics also invested in Nesco. Having said this disclaimer, I want to disclose that. I want to tell you that throughout my career, this is the one stock which has given the maximum confidence to me because of few reasons. One, it has got us nearly 65, 70 acres of land in Goregaon, Mumbai, and adjoining the metro station, which is expected to come up within 1 or 2 months. And if you look at world over, whether it is Singapore, Hong Kong, London, wherever the metro station is there, that gets developed as a successful commercial hub. Now, Nesco having a lot of surplus land after even developing some of these IT parks and exhibition centers, in my estimate, they still have around 25, 30 acres of land which can be used for developing corporate parks. So once the metro station is commissioned, this should give a short-term trigger. And second, extraordinary management. In the last 10 years, they have increased the capex substantially, but still the cash is also increasing. As of this September 30th, the free cash is around 1,000 crore, despite a substantial buildup of the capacity. Recently, they have commissioned a new IT park. Despite that, the cash is so much, and they already planned another mega IT park, and that should be commissioned in 3 to 5 years, and that again should be financed through their own internal accruals. And third, the reason is that the September result was phenomenal. Whether you take year on year or quarter on quarter, net profit has gone up substantially, as much as 54% is a jump in the net profit year on year, and even sequentially it has gone up somewhere around 53% sequentially, around 57% year on year, and that's because the exhibition center has turned around. Now there is a lot of scope for exhibition center to improve the profit, because the chemical sector has proposed a mega exhibition in 2023. So considering all this, I believe the fair value could be around 800, but I believe in 3 to 5 years this Nesco stock can become a phenomenal multi-bagger.
Okay, so fair enough. Everyone's been very gung-ho on some of those financial names of late, Mr. Chokkalingam. Would you have a broad-based view on it, or would you say that select names are looking better? Would they be the frontline names? Would they be some of the mid-caps that have outperformed more recently?
Yeah, definitely. As you rightly said, this is a time for the banking stock to improve further their performance on the stock market. Because during Corona pandemic time, the banking credit growth has come down as low as 5%, historic record low level. But now it has picked up to 16 to 17% year-on-year growth, which is again another record. And another very interesting fact, which all of us know, that the net NPA cycle already peaked out. For the last 2 3 quarters, the banking sector has been reducing the net NPA substantially. Third, as even RBI governor mentioned, that I think in India the inflation rates already peaked out. It started slowing down, and the monsoon also has been good. Both the Rabi crop, Kharif crop are expected to be too good. So all these point towards modest inflation, the modest net NPA levels for the banking sector, but record level of credit growth would continue in the short term. So all this would augur well for the banking stocks. So among the large cap stocks, I would say that HDFC Bank, till recently it was underperforming. Now last couple of weeks it has picked up. I think still long way to go for HDFC Bank to reward the investors. In the small cap banks, I would suggest Bank of Maharashtra. According to me, it looks like a mini HDFC Bank in terms of the growth and asset quality. So these are the two stocks. One can add even Kotak Bank also, that also underperform, but now time has come for Kotak Mahindra Bank also to outperform. So these are the 3 banks I would suggest.
The recent rally in these FMCG names, Mr. Chokkalingam, ITC, Britannia, are you buying into that even at the high levels?
We stick to Hindustan Unilever. ITC we recently closed. I am a little afraid that there can be two negative triggers for ITC. We don't know when the government will press the button for divesting its stake. It is possible before March 31st because of the fiscal deficit condition. That would be one negative trigger, because that might come under some discount to the market price. And second, the government has not touched a cigarette in the short term. I feel that there is a chance that the GST, the taxes on cigarettes, can be hiked significantly in the short to medium term. So therefore, I would avoid ITC. I would stick to HUL, and I would also buy Nestle around 20,000. Upside could be only about 1,000 rupees, but anything below 20,000 is appealing by Nestle. So these are the two names I would suggest. Britannia, yes, in case there is any correction, because after the results it has gone up a lot. But if there is a small correction also, then one can consider Britannia.
All right. I'm also going to go across to Tanya on the Paytm and Nykaa, performance today, with Paytm plunging and even Nykaa deepening its losses. Tanya, take us through some of the factors at play here. All right, let's go back across to Tanya in a moment. I think we can't hear her properly. Mr. Chokkalingam, I know I discussed Paytm with you earlier, but do you have a similar view on Nykaa, or does that buck the trend?
ICA is slightly different from Paytm, as all of us know. It makes some bottom line, but still extraordinarily rich valuation. Now look at the Reliance. Reliance Retail also getting into similar business model. They have got both e-commerce and new commerce. I am, I am bit nervous to buy even Nykaa at current level. I would be comfortable if Nykaa corrects at least 25-30%. Otherwise, I would stay away from Nykaa also.
All right. I'm just going to take a look at some of the other movers today. We've got, a mixed bag. Names like a Tata Coffee, Godfrey Phillips that are seeing some gains jumping up and about, KPIT Tech, NIIT, Raymond, Tata Consumer. So a whole lot of the consumer-oriented stories for sure. What's your view on discretionary, Mr. Chokkalingam, or which segment when it comes to consumer, would you be bullish on in terms of the discretionary pocket?
As we discussed, partly, some of these have already gone up. Whether so I'm not that comfortable on the consumer discretionary. So rather I would stick to the financials. I would even stick to the stock like a Bharti Airtel, because I'm very bullish on the telecom sector. The government needs more money through non-tax revenues, and that is possible if they encourage the mobile companies to keep rising the tariff. And also some of these, the hospital stocks, like Coway Medical, which is the cheapest. I remember we discussed last time, it has gone up slightly, but still it is, the valuation wise, it is 1/3 of the other hospital stocks listed on the market. So these are the stocks which give me a lot of comfort and confidence rather than, the discretionary space.
All right, a couple of others, as you can see on your screen: Mastech, Quest Corp, some of the names that are at their 52-week lows, in fact, today. So we do have some of those in the market as well. IT names, Mr. Chokkalingam, are they, any cautiousness there according to you?
No, I think this is a best time still to do, bottom fishing in the IT space. As we discussed last time, IT sector has been hammered more than what it deserves. It will come back, valuations will improve, the employee cost problem will get moderated, and I would suggest names like Wipro. Tactically, Wipro can give minimum 20-25% return, because it has already fallen 45% from the peak. Not only that, I mean, it's very attractive now at value in terms of valuation. And second is Oracle Financial Software Solution, that is OFSS. That is a great value stock in the large mid cap space within the IT. The stock has corrected nearly 40% from the peak, and it trades around 13-14 P on 1 year forward earning. It's a subsidiary of $40 billion company. I am surprised that it is trading at such a cheap valuation. Another very interesting fact is that it is sitting on a cash of around 5,000 crore, and it is also known for rewarding shareholders quite regularly. The dividend yield alone can be close to 6%. So one can sit on this stock until you get 30-40% return. One can enjoy dividend yield of close to 6%. The small cap space, I would suggest Gensar. I also hold Gensar personally. Gensar technology has come down nearly 60% from the peak, and I always adopted the parameter like enterprise value to annual revenues for the small IT companies. Based on that, I had earlier predicted a few acquisition which happened. I'm not saying Gensar would be acquired, but I am trying to say that there will be more acquisition in this IT space because the entire industry is growing at a poor single digit in dollar term. So there is a scope for more acquisition. When such thing happens, companies like Gensar can be re-rated, which is the cheapest in terms of enterprise value to annual IT revenue. So these are the three stocks I would strongly recommend within IT space.
All right. Thank you for that, Mr. Chokkalingam. And thanks for joining us on the show today. Now, the global pessimism is likely to hit the Indian economy. In an exclusive interview with the Business Today TV, Pranjal Bhandari, the MD and Chief India Strategist at HSBC, has warned that a dip in exports could hit India's GDP growth.
Can you first tell me what is the shape of the growth curve looking like? Is it an L-shaped recovery? Is it a K-shaped recovery? What is your views on this?
Well, look, I think growth has been strong in the last couple of months, but I also think that it's going to slow a little bit in the next couple of quarters. And the big reason for that is global slowdown. I think globally we are headed for a slowdown, slowing growth, and that means India's exports weaken a bit. India's exports have been a huge driver of post-pandemic recovery, and if that slows, then India's GDP will also slow. So I think that's coming, and we need to be prepared for that.
We also know that there's a increasing gap between the haves and the have-nots in the sense that the purchasing power of a lot of tier 2, tier 3 cities has been stripped off. So what can what can the country as a whole do to sort of see at recovery in a big way at the macro level?
Yes, you're right. I think K-shaped recovery is probably the right alphabet we've seen coming out of the pandemic. Large firms, employees of large formal firms, high-tech firms, skilled workers have all benefited through the pandemic. But on the other hand, small firms, informal sector firms, low-skilled workers, low-tech workers have actually seen their salaries fall or even sort of, their jobs go away. So I think this is a problem we are moving with. We are not really acknowledging it fully because our GDP data does not capture it. But over time, I think we will have to pay a price for it. What do? There is no quick fix. This is a function of important reforms. And I think the big problem we have in our country is that many small firms remain very small for very long. We need an ecosystem in which small firms grow over time, become large, and the people who work in these small firms start earning more over time. I think that is the right ecosystem we need. What do you need to get that done? We need all kinds of reforms. Ease of doing business, version 2, better access to finance, access to skilled laborers, better skilling institutions. I think we need a lot of reforms. We have made some progress, but we have to make a lot more progress over the next decade.
Can you first tell me what is the shape of the...
All right. Let's also go back across to Tanya on really what happened to Paytm and Nykaa today. We're closing down just under 62,000 on the Sensex, 240 points down. Still not too much to worry about. But what happened to those tech biggies? Tanya, take us through.
Absolutely, Aabha. So basically, shares of Paytm took a beating today. It tanked over 10% amid reports of block deals after the lock-in period expired for pre-IPO investors. Now, according to the reports, SoftBank may have sold $200 million worth of Paytm shares in a block deal. And remember, the price range for the sale was set at 555 to 601 rupees. SoftBank had a 17.5% stake in the fintech company and was planning to sell about 4.5% stake in Paytm. And now it is also important to note that now there is a 60-day lockup period for further stake sale by SoftBank. Similarly, for Nykaa, the stock, however, managed to recover and was trading 1% higher in the afternoon trade today. But the shares were down to the tune of 7% today in early trade on the back of heavy volumes after multiple trades took place in the block deal window. Now, ever since its lock-in expiry, the counter has seen several trades. Yesterday, Lighthouse India Fund also sold 3 crore shares of the company at an average traded price of 175 rupees. Remember, on 11th of November, Morgan Stanley Asia and Society General also purchased a stake in Nykaa according to the block deal data available on the Bombay Stock Exchange. Now, the one-year lock-in period for Nykaa also got expired last week on Thursday, and the scrip also turned ex-bonus the very same day. And since then, the scrip is seeing heavy volumes. So shares of Paytm have tanked over 58% in 2022 so far, and Nykaa is also down over 48% in the same period. Back to you.
Thank you for that, Tanya. So just to sum up then on today's session, let's take a look. 61750 for the Sensex, 18333 or the Nifty, and we had IT and auto, some of the major drags today. That's where we settled, still trending at those high levels. Nothing too much to be concerned about as of now. But yes, some of those tech names were definitely very much in the news today. There you have it. The IT index is down just about 1% or so. Auto also down about 1.5%. Finance, pharma, about 0.5% each on some of those indices. And in terms of the losers, you had names like an AU Small Finance, which is down about 2%. We'll pull up some of the other losers for you as well. I'll just pull up that list. And on your screen, HDFC Bank, Kotak Mahindra Bank, SBI, some of those financial names that were definitely trending on the lower side from the finance bunch. Other than that, Aisha, Apollo, Hindalco cooling off in today's session, to mark a few other names. And from the IT pack as well, we had a couple of names. Maruti from the auto pack, Grasim, Dr. Reddy's, summing up some of the key losers in today's session. That's where we leave it on the show today. Thanks so much for watching.
From the makers of Aaj Tak and India